And now, an Envision Financial podcast with Luke Smith on Canberra's 2CC.
Good afternoon, Luke Smith. You found that amusing for some reason.
There was two components of that that were amazing. It was the lead-in of "We're here." It was the ultimate radio intro, and then Mudgy. Oh, it's gold. It's made my week.
Don't knock Mudgy.
Mudgy's lovely. No, look, big shout out to Mudgy. You know,
good wine.
Good wine there.
Yeah,
yep.
Absolutely.
Pretty sure there's a gin distillery up there somewhere as well.
There probably is. There would be.
You had me at hello.
Absolutely. So the Raiders and the Panthers tonight, 6 p.m. It's going to be
good.
Absolutely huge.
Go Raiders.
We're here today to talk about, can I make a deductible contribution to my super if I'm a member of the PSS?
Yes.
So I'm going to assume if I don't know what the PSS is, I'm probably not a member.
Correct, that's right. So a little bit of context here. We're gonna debunk something that I've had 6 or 7 times this week, which I think is costing people lots and lots of money. And PSS is one of the 4 defined benefit schemes. We've got CSS and PSS for normal people, and we've got DFRDB and MSBS for the military. And there are still some CSS people floating around, but that's the older scheme, and the majority of the defined benefit members now fall into that PSS bracket. And I'll say this, and I don't must anything really in my life, but it would be a wonderful, wonderful decision financially if you are in that fund to get to 10% as fast as you can before any other financial decision. All right? That is how powerful the formula of this fund is. Now, that's not the basis of today's conversation. Today's conversation is about removing the ongoing innuendo that I get 5 or 6 times a week when somebody walks in and says, I'm in the PSS and I put 10% into my fund and that is all I can do. Right? No, it's not. So, if you are a member of the PSS, the best thing you can do to maximise your membership in that fund is to get your final average salary in the last 3 years as high as you possibly can. And then make a 10% contribution, because that maximises the calculation of your accrued benefit multiple. And for any member listening, on the second page of your statement, they have some lovely light green circles, and you see the formula for the fund. Final average salary multiplied by accrued benefit multiple equals value. So the greatest thing you can do to maximise the value of your final entitlement and therefore your pension for the rest of your natural life, sort of important, is get your final average salary up and get your 10% contribution in. Now, you can take that further, and what you do, what you should be looking at, is going to page 5 of your statement. On the bottom of page 5, there's a little box. The second row of that little box says, your benefits counting towards your concessional contribution cap for 2025 are, and there is a number in that box. Let's say, for illustration purposes, that number is $10,000. What that number represents is the employer portion of your contributions used up in your annual concessional limit, which is $30,000. So we know that people can put a contribution into super up to $30,000 and claim a tax deduction. The PSS allows a maximum of 10%, and that contribution is an after-tax payment. So if you want to maximise your accumulated superannuation benefits and lower your tax at the same time, you go to page 5, second row of that box. What's my number? My number's $10,000. You take that $10,000 off the $30,000 annual limit, and that is the amount of money that you can put into superannuation and claim a personal tax deduction into another complying super fund. Okay? It cannot go into the PSS. It does not accept that type of contribution. I'm not saying we don't want it in there. You just physically cannot put it in there because they do not accept it. So you'll need to open another fund anywhere you want and make a contribution. 2 ways you can make that contribution. Go to your employer and say, hello, Mr. or Mrs. Employer, I'd like to put $20,000 over the next 12 months into X super fund. And they will facilitate that for you on a pre-tax basis. Or you can save during the year into the offset account of your mortgage if you have one. And then in June, you can call up the fund and you can say, what have you recorded against my concessional cap for this year? They will give you that number over the phone. You can also log in to the online portal for PSS and get that information off the portal. That number is set on the 1st of July every year. So your statement from the last financial year is a great indication, but don't trust it because the number may change in the new financial year. But it gives you a great starting point. So call up the fund in June and say, hey, what's my number? They will read out your number in about 15 seconds after they've ID'd you. You take that number away from 30,000. And if you've made no other super fund contributions to any other funds, that is the amount of money you can put into superannuation and pay 15% contributions tax, which is highly likely going to be less than your marginal tax rate. If you use your own money, we've spoken on many occasions, lodge a notice of intent with the fund that you put the money into after the money has gone in. That will give you, in this example, $20,000 contribution in June. Notice of intent to your other fund. You get a $20,000 tax deduction when you lodge your tax return in July, and you've only paid 15% on that money. Wonderful, wonderful saving. If you're earning 39, 49% tax rate, you're saving huge amounts of money. So don't get halfway to the finish line and trip over. Maximize your contributions and know that you can do more than your contribution rate to the PSS to, one, bolster super, and to, two, lower your taxable income. But the water cooler talk in some departments is hurting people financially, because I've had 4 people this week walk in and go, I'm doing all I can. And I go, no, you're not. Oh, Jenny at work didn't tell me about this. Well, Jenny's working in the department of doing something. It's probably not her forte. So get the facts. These are the facts. Make the most of these facts and lower your taxable income and bolster your super during the financial year while you can.
So when we ask the question, can I make a deductible contribution to super if I am a member of the PSS? The answer is yes, you can, but the proviso is you actually need to set up a second super account where the money can go.
Exactly right. Your 10% contribution goes to the PSS, and that's fine. Keep doing that. Your other contribution that is personally deductible to you must go to another fund. Okay, and again, we're not saying there's anything wrong with PSS. Wonderful fund, stupidly generous, and it's saved an entire generation of employees. It must go somewhere else because they just do not take that type of contribution. Yeah. It is not designed for that.
So I guess some people just assume, I've got the PSS, I can't have another fund.
And this is exactly why I'm having that conversation with you today, because people are leaving huge opportunities on the table, and it's absolutely killing me to have to say the same thing. And the look on people's faces is this shock and disbelief that how come no one's ever said this? How come PSS hasn't explained I can? Well, they can't talk about other super funds. So it's about understanding what the legislation allows you to do, understanding the benefits of that fund, and again, wonderfully generous fund. Now, if you have a transfer amount, okay, that is an amount of money that you have rolled in from another fund when you join the PSS. So on your second page of your statement, you'll see, as we said earlier, final average salary by accrued benefit multiple gives you value, right? They're light green circles. There's a box at the bottom of that second page. In the middle of that box, it'll say transfer amount. And there may or may not be a number. Now, if you want to make contributions to another fund and you don't have any money in a fund at the moment, you can roll over that transfer amount to a normal super fund, so anything outside of the PSS, and it does nothing to change or impact in a positive or negative way the calculation of your pension entitlements under the defined benefit rules of the fund. It's just money that you've rolled in because you probably didn't have another fund, and somebody said at the start in 1992, hey, roll this in, keep it all in one place. It doesn't help your pension calculation. It just sits there and it gets paid out as cash when you leave. So if you want some seed capital in your new fund because you plan on making contributions yourself, you can go to the PSS and say, hey, give me a form to roll that over. You give them your new superannuation details and they will roll that over for you, and that can be seed capital in your new fund that you can then direct deductible contributions to up to the limit using the space on page 5 in the bottom of that box.
So bottom line is, just because you've got a super fund doesn't mean you're not allowed to have another one.
Totally. Oh, you can have 10.
Okay. It's just that in normal circumstances, there's no real reason to do that.
Well, and this is where these funds are unicorns in the sense that they play by a different set of rules because they are structurally different to what we would call a standard accumulation fund, which would be a personal super fund, an industry fund, a self-managed super fund. That's a standard accumulation fund in the super world. These are defined benefits. They're defined by a calculation. So they have slightly different rules and regs that you play with, but you can have the best of both worlds. And I think you're crazy if you don't, but I want people to stop coming into my office and going, I'm doing all I can't do that. Well, yes, you can, and this is exactly how you lower your tax, and everybody loves a tax deduction.
Yes, they do. And they also like a bountiful superannuation at the end of their working life.
Exactly right.
Indeed. Luke Smith from Envision Financial is with me in the studio today, and we're talking about making a deductible contribution to super, even if you already have a membership of a PSS. And we're explaining all the nuts and bolts and details for you.
Yeah.
Turns out it's a very simple answer.
Yes.
That's it.
Doesn't get any easier
That's
than
the
that.
answer. Yes, you can.
Yeah. So,
What are the key things to remember?
As we said before the ad break, check your space. How do I do that? Go to page 5 of a statement. There's a box at the bottom of the statement. The second row of that box says concessional contributions counting towards my 2025 cap. That number is what PSS is recording against your $30,000 limit. Take $30,000, remove that number. That is the amount of money that you can direct in various ways to another superannuation fund. You can salary sacrifice. You can make a personal deductible contribution. Do it during the year. Do it in June. If you do it in June with your own money, you must lodge a notice of intent with the fund to tell the fund, hey, I've put in 20,000, 15,000, 10,000. I'm going to claim that as a tax deduction. So it's notice of intent is a regulated ATO form, standard. You can download it. Quick Google, ChatGPT, it'll find it for you. Send that into the fund after you've sent in your cash. Okay, but don't make the mistake of being in a wonderfully generous fund and make a 10% contribution where you can. The reason I stress that is that it's a direct accelerator to your final benefits because the formula is final average salary by accrued benefit multiple. Your accrued benefit multiple is a representation of your contribution rate, okay? And the numbers matter. The big problem with PSS, you can't catch up time. So if you have a year where you haven't put in 0.31, which is a 10% contribution where you've had more than 10 years of membership, you can't go next year and say, oh, well, I'll do 15 next year and catch it up. So it's use it or lose it. So get to 10% as fast as you physically can, and then make sure that you're adding to superannuation to, 1, bolster retirement, and to 2, lower your taxable income. Because if you earn $180,000 and you throw 20 grand into super because that's the amount of space you have, you've got a $20,000 tax deduction. You'll pay income tax on $160,000. You'll get a refund when your tax return is lodged, put the money back in your offset account, and around you go again. So if you want to bolster super contributions, think about it like this. As you approach 60, if you have a mortgage, would you rather pay your house off and pay 39 or 49 cents in the dollar? Or would you put the money into superannuation at 15%? Quit at 60 and pull it out tax-free. You've effectively paid down a non-deductible home loan at a maximum tax rate of 15%, whilst you're still bolstering your PSS pension entitlements with a 10% contribution. So don't let somebody at work go, oh, you can't do that. You can. Yes, you can. And that's exactly how you do it. Page 5, second row of the box, get your number, call up, ask for the number, log in, get the number. But get the number before you make the contribution because that number is reset each year on the 1st of July. So your 2025 statement and your number for the next financial year might be slightly different, depends on what you've had pay-wise, job-wise. So just check before you put the money in, get it into the fund, get your notice of intent in, or go to work and say, hey, Mr. or Mrs. Employer, can you salary sacrifice X amount of money? And I'll throw a little bit more in at the end of the year. But make the most of this opportunity, because people are leaving thousands of dollars of tax savings and accumulated super on the table, which is doing my head in.
I can understand that. So we've reached the point where it's time for me to ask you, Luke, where can listeners get more information?
Yeah, so office number 6260-4749. We've got envisionfinancial.com.au on the internet. We've got the podcast, The Strategy Stacker. Luke Talks Money on iTunes and Spotify. We've got Envision Financial Canberra on YouTube, where we've got a back catalogue of all of our shows so you can sift through what we've done in the past. And we've got Smart Money Strategy, your ultimate guide to financial planning, in just about every bookstore.
I just saw it the other day.
There you go.
I was in a bookstore and look, there's Luke's book.
I went into one the other day. They said, oh, sorry, we're sold out. There's more coming. I was like, oh, okay. She said, do you want one? I said, no, it's okay. I know the bloke.
Yeah, there you go. Thanks very much. We'll catch you next week.
See you next week.
Luke Smith from Envision Financial, back again at the same time next Friday.